Hey, what's going on YouTube? In this video, we're going to talk about Disney, ticker symbol DIS. They just reported their Q4 earnings and they missed on revenue but beat on EPS. And the big portion of why they beat was because they are continually aggressively managing their cost base. They previously had a target of $5.5 billion in cost savings, but this most recent quarter, they upped that to $7.5 billion in total cost savings. So once we go through all the financials and everything, we're going to run through the calculator one time, like as the financials are today, and then add in about $7 billion of cost savings. I'm sure they've implemented some of those savings already. So we'll figure we'll take a little bit of some of those, that 7.5 billion, maybe we'll reduce it down to like 6.5 billion and add that into their net income and see what the value of the company could be with those numbers included. So Disney Plus added nearly 7 million core subscribers in the fourth quarter, and we can see now subscriber growth is up to 150.2 million subscribers on Disney Plus. So nice subscriber growth. Forecasted was 147 million subscribers. So Disney said it continues to expect combined streaming business will reach profitability in Q4 of 24. So I'm sure that has a lot to do with the cost savings basis that they're working on. That might be part of the reason why they're forecasting a profitability in the Q4 for their streaming services. But in the after hours, Disney is up about 3%, up to $87.15. Year to date, Disney is down about 5%. Over the course of 1 year, down 15.4%. So we're going to run through the previous financials real quick, just kind of go through those and see where Disney is standing financially. Then we'll run into their most recent earnings report, and then we will run through the valuation calculator and figure out what this thing is worth. So we've got all three of our gross profit, revenue, and net income here. I mean, the revenues are growing, but gross profit, net income are not. We can see that very clearly on here. As revenues grow, everything else does not. So not ideal. And we can see net income is hanging on by a thread and sticking in the positive territory. Gross margins, 11.8%. Historically, up until 2020, this company was doing very good gross margins. Net margins were also significantly better than where they are today, sitting at only negative 2.1%. And that is the last quarter, currently trailing 12 months, 2.7%. Revenue, gross profit, year-over-year change, we can see not much for revenue is growing, gross profit relatively flat. Return on invested capital, about 2%. PE ratio, 68.7. Earnings yield, 1.5%. Cash to debt, cash to short-term debt, they have about $11.5 billion in cash and about $28 billion in short-term debts, and a lot more long-term debts included of $93 billion and $11.4 billion in cash. Net income to free cash flow, we can see company produces more free cash flow than net income, so we'll take a peek at that. We can also see up here that company does pay out a lot of stock-based compensation, so that's going to attribute a lot of that to the free cash flows. But we can see positive free cash flow is still at $2.8 billion. CapEx has been pretty steady, hasn't really grown too much, and is sitting at about $4.7 billion. Share count dilution, they are still diluting shareholders because they are issuing stock-based compensation but not buying back shares, so the dilution on the share count is increasing. Dividend, no dividend currently on Disney. There once upon a time was, but 2020 hit and they cut their dividend to 0. So now on to their most recent report that they just announced today. So revenue is $21.24 billion. That's a 9.9% gross profit over the course of the last quarter. So slightly down from where it currently is on the trailing 12 months. They do have restructuring and impairment charges. Hopefully this will soon be gone, and then maybe we'll get an additional $1 billion carried down to the net incomes as well. But sometimes, there still might be some impairment charges here every now and again if, like this one's got 200 million. But if they can reduce, this most recent quarter, they did 4 billion, the most recent year, they've done about $4 billion in impairment and restructuring charges. So hopefully that gets eliminated in the near future. But then down here we get net margins of 3.2%, slightly higher than the trailing 12 months of $694 million. As we can see here, shares year over year are up 7 million. Down here on the assets, we can see we're at $14.1 billion in cash. We've got inventories are kind of ticking up a little bit, sitting at about $2 billion. They were previously at $1.7 billion last year. So we come down here, we got $4.2 billion in cash, and all their debts do carry down. There's nothing we can eliminate out of their debts and their short term. So it is a genuine negative $16 billion after they pay off their debt with all their cash. They are left with still $16 billion left to pay out. Company does have $46 billion in retained earnings as well, and they can use that within the business as they choose, as dividends or share buybacks, or just fixing up the parks or whatever they want to do with that money. Net income from continuing operations. Company did produce $3.4 billion of net income. They get to add in depreciation, amortization, impairments as well. Here's your stock-based compensation. It's a big number on their cash flows. And then cash provided by operating activities then comes down to $9.8 billion. We have CapEx of about $5 billion here, which then leaves us with about $4.9 billion in free cash flow in the last 12 months. So now we're going to run through the calculator as the company sits today without adjusting anything besides the EPS that after earnings came out, it is up to the most updated EPS as of today's numbers. So Peanuts fair value gives them a price per share of $71.76. Manual PE, you take your market cap minus cash, add in debt divided by cash from operations. It'll tell us it takes 31 years for this company to earn its market cap. Price to book at 1.39. PEG ratio is telling us we are really overvalued. Graham's valuation gives them a price per share of $121.16. Discounted cash flow. They currently, history tells us that average growth rate is 19%. Analysts are at 51%. So I gave them 35% free cash flow growth rate, and that gives them $106 per share, while $105.78. Rule 72, we have three sources of EPS growth rate for an average of 20%. That goes into 72, 3.72 times, and then that goes into 10 years, 2.7 times. That doubles our EPS 2.7 times, so basically just shy of 3 years. I gave them a future EPS of 9, which gives them a fair value of $87. Now, onto the summary. Disney currently trading at $84.50. Obviously, post-market, it's slightly higher. It's about $3 up. Fair market value, we got, based on current numbers today, of $96.43. 30% margin safety, $67.50. Analysts have a price target of $110.55 per share. Now, let's implement the cost savings that the company is working on doing. So let's say it's $6.5 billion. So actually, you know what? Let's say it is the full $7.5 billion, because obviously what we're going to do is factor in no revenue growth, and we're also going to factor in no share count dilution growth either, but obviously that will likely be getting slightly diluted. But we have revenue of $88 billion today, annualized. If we save $7.5 billion of cost of sales or cost of revenue, that then gives us a net income potentially could be $10.8 billion. So then that makes our EPS roughly 5.9, and then our PE would then be 14.7. These would be obviously be forward-looking numbers. So let's plug those two both into the calculator real quick. And then we're also going to change our EPS growth rate beyond that. Let's assume like a 25% EPS growth rate. So Peter's fair value then is $147.50. And then we come over here to Graham's valuation, gives them intrinsic value of $270.71. Discounted cash flow. So then here's where things get a little bit tricky, but obviously if they bring $7.5 billion to the bottom line, free cash flow should grow. It minimally should grow at least half of $7.5 billion, if not more than that. So there's a real good chance their free cash flow forward looking could be like $8 to $9 billion. So currently we're doing about $4.9 billion annualized. Obviously, that's not including the most recent quarter. So we can plug in, like, let's say $5 billion. So $5 billion, maintaining a free cash flow growth rate of maybe 35%, maybe. That gives them a DCF price per share of $220 per share. Rule 72, then we get to adjust this number down here as well. I'm just going to give them a future EPS of about 20, and then that'll give them a fair value of $193.33 per share. Then what that does to our fair market value that we could potentially assume is relatively close to correct, would give us a fair market value of $208 per share, 30% margin safety, $145 per share. Now, the other key component to this too, as the only thing we really change is we reduce the growth rate. Growth rate could still be a little elevated. We obviously maintain a 35% growth rate on free cash flow. Is that sustainable? Well, we don't really know, but they do have a history of doing, obviously we already changed that, but it was like 19%. And then obviously we changed our EPS growth rate from 55 down to 25. So in 3 years' time anyway, they're forecasting 21, 22%. We're forecasting out about a year, roughly. We're assuming potentially within 1 year, this company can reduce costs by about $7.5 billion. So forecasted on from analysts, we're expecting 29 to 22%. So 25% seems fair. So those are the big changes. Now, the other change that could happen is the company could begin to offer a dividend again, because if they're going to add potentially, $3, $4 billion to free cash flows, which we can come down here, $2.8 billion, you add $3, $4 billion to that, you're sitting up here. You're sitting about $6 to $7 billion in free cash flow. Well, you come over to here, the company was paying out a dividend. Company was also buying back shares at that free cash flow amount. So that could also contribute to a higher EPS. Obviously, then it pays out a dividend, so it's even more attractive to investors. So I think there's a lot of positive things, especially if they can really cut costs, if they can really truly, and it seems they seem very confident because they upped their expectations from 5.5 to $7.5 billion in cost cuts. So I think that is going to be a key driver and component to these future financials of this company. And honestly, if you believe them, which I kind of do, uh, this company could see about $200 per share potentially in the not too distant future. Give it a quarter or two, and we can start really seeing those cost savings show an impact on these overall financials. And I think things are going to start turning around over here on Disney, and we might start seeing some upward momentum in the stock price. And speaking of the stock price, I have drawn like a little fake green candle here. We are on the weekly chart, so depending on where the stock opens tomorrow, it could be in that range. But if it does open up in that range, we would then have, in my opinion, confirmed a break of trend. And instead of locked in this downtrend, we have now broken through this trend. And because numbers weren't too terrible over here, and guidance isn't that is pretty decent as well. Looks like things are starting to turn around. I think the stock price is also on its way to turn back around. So I could see Disney starting to trend its way back up into the hundreds, low to mid 100s in the future. Probably not right away, but it's probably going to take its time getting there. I think a couple earnings reports will start pushing this stock much higher, and we might actually be able to see up to about $200 per share again in Disney potentially. I mean, if based on what we just did, it's likely. I can see it happening, but right now, uh, you're trading at $87 per share, and if this thing has a chance of getting up to even double, you figure you could double your money on Disney possibly, even if our numbers are a little wrong. That you still throw a 30% margin of safety on that number that I threw out there of $208 per share. 30% margin of safety, fine. It's $145 per share. That's still $60 away from where it is today. So even if the numbers that I presented were a bit high or elevated, there's still a 30% margin of safety baked in that you can use as well on this and what we just went through. But that is it on Disney. If you found value in this video, drop a like, subscribe, and comment. We'll be back later with another stock analysis video.